New York City, Thomas J. Hayes, selaku Chairman and Managing Member Great Hill Capital LLC. Good afternoon from Indonesia, Thomas. How are you? It's good to have you both here, Thomas dan juga Pak Raden. Okay, we're going to the first question. To you, Thomas, we've heard about the Silicon Valley Bank collapse followed by the news of Signature Bank. We can imagine 100 hours of chaos there in the United States since Friday. So can you describe it to us? How's the condition right now? And can you explain how chaos is this right now, Thomas?
Yeah, well, Aoife, thank you for having me. It's early here in New York, but happy to be on with you. You know, Warren Buffett, one of the greatest investors of all time, he says, you never know who is swimming naked until the tide goes out. And I think that's exactly what we saw with Silicon Valley Bank and several others. This bank dealt exclusively with venture capital firms and startups. That was their client base. And during the pandemic tech boom, their deposits grew to $200 billion. So what they did with that money is they bought what were perceived to be seemingly safe assets. They bought longer dated U.S. Treasury bonds, and they bought mortgage-backed securities with government guarantees on them for about $128 billion worth. What happened, Aoife, was that due to the aggressive, nonstop tightening by the Federal Reserve, that portfolio of bonds took an unrealized loss down from par value of about $17 billion. That was largely caused by the Fed. And what happened was, as the tech boom of the pandemic slowed down as well, clients burned through some of their cash and deposits, so they were drawing down their deposits, and it was harder for them to raise cash through public offerings or through VC firms. So not only did you have a hole in the bond portfolio, temporary impairment, but also you had the deposit base going down. And to solve that problem, their deposits had gone from about $200 billion at the peak to about $173 billion by the end of last year. To solve the problem, management sold a large chunk of its securities, about $21 billion at a loss of $1.8 billion. They were trying to lock in higher yields and create the balance sheet flexibility to meet potential outflows and still fund new loans. And it wanted to do at the same time a $2.25 billion equity raise, but they kind of fumbled the ball. And when people heard about it, you saw a massive withdrawal of deposits, because most of the deposits were large institutions versus individual depositors. So the money flew out just as quickly as it flew in. Couple that with a short-term impairment in the bond portfolio, and that's why you saw what you saw. So, you know, this is not exclusive to Silicon Valley Bank in the sense that there are $620 billion of unrealized losses across regional banks. However, the Fed did step in and said, listen, we understand if you own government securities that eventually they're going to realize at par over time. We will allow you for a period of 1 year to borrow against the full value of your bond portfolio, provided they're in government securities and government-backed securities. So that alleviated things. What they have to worry about now is keeping the deposit base in the banks, because on the one hand, if you solve the balance sheet issue, that's a good thing. But the key is to keep the depositors in. And now you have banks competing with the U.S. Treasury with the high yields on the short-term bonds to have to pay more money to keep the depositors in, which hurts their income, which is part of the reason you saw Silicon Valley Bank further out on the curve than most people thought they should be. Because if you think back a year and a half ago, there was no yield to be had. So in order to get any income for their shareholders, they had to be further out on the risk curve, which was the design of the Fed initially to keep rates so low. And that caused this problem. So I would say, number one, they could have managed their portfolio a little bit better on the short end, or as they saw rates going up, start to move to the shorter end of the curve. But this was largely created by the Fed. It's almost like an insurance company. Yeah. You pay them insurance to insure your house, and then all of a sudden they set your house on fire and they say, what did you do? But I think the Fed played a big role in this.
Okay, it's quite chaos from the depositors' perspective, and yeah, it's we were worried that it's quite contagious, of course. But Saya akan ke Pak Joshua berikut. Okay, so moving forward to Thomas. So from your explanation earlier, so how contagious is these cases to the banking industry in the United States, and from your 2 cents, from your point of view, how is the impact to the other countries, especially Indonesia?
Yeah, well, I think the contagion is going to be contained, and that's because the Fed stepped in relatively quickly. They probably waited a day too long, but for 2 factors. Number one, the banks can borrow against the par value of their portfolio, so the impact of the unrealized losses will be less severe. That's a good thing. Number 2, they also stepped in to guarantee depositors' deposits, which is critical for Silicon Valley Bank and for a couple of the other banks. What they need to do is come up with some program that says all deposits are guaranteed in the United States. Otherwise, what you're going to see is all of the deposits go to just the 4 big systemically important banks like JP Morgan, Citi, Wells Fargo, Bank of America, et cetera. And you don't want to see that, because if all the deposits leave the regional banks and just go into those 4 big banks, you really do have a situation of too big to fail. So hopefully they'll come up with some program where everyone feels confident, whether they're a business with a large account or an individual with a smaller account, that if they put money into a bank, their deposits are safe. And once they do that, the contagion will stop. They haven't done it yet, but it's implicit in the fact that they stood behind Silicon Valley Bank and Signature Bank, that they'll do it for other banks. As it relates to opportunities in Indonesia, in emerging markets, I think this is very, very positive for emerging markets for a couple of reasons. Number one is it's going to cause the Fed to stop doing what they did to break the system.
Yeah.
So the Fed often tightens until they break things. We saw Silicon Valley Bank was a broken thing. So likely, at the most, they're going to do one more 25 basis point hike. We think they may do 0. And if they do 0, you're going to see bonds continue to get bid. Yields are going to come down. The dollar is going to be weaker, and that's a very, very positive thing.
Okay, so you agree with Goldman Sachs, Thomas?
Yes.
Okay. Okay, and this is very interesting, and we will discuss more about this, how this will affect to the Fed's policy in this March FOMC. Tapi kita akan jeda terlebih dahulu this March. So what do you think about this, and what is the urgency for the Fed to keep its the rate stays at this level? And what is the scenario if the Fed still hikes its interest rates to 25 basis points?
Yeah, I think that would be okay. I do think they need to guarantee the deposits across the country in order to do that, because basically what you're seeing is now interest rates have gotten so high on the short end that banks are competing with the government for depositors' capital. And if deposits keep flowing out of banks and into T-bills, that's not good for the banks, and it's going to cause the Fed to have to step in and bail out more banks. So if they guarantee the deposits, it should be okay. But at the end of the day, what they should come to the conclusion of is they aggressively hiked rates without stopping, without a willingness to see how the system took it until they broke something. And now that something's broken, if you continue to do the same thing and expect different results, that's the definition of crazy. And so to continue to hike after you're starting to see breaks in the system, in our view, would be a bad idea. But 25 basis points hikes additionally probably wouldn't be the end of the world. But they do need to say, if they do it, this is it. This is the end of the tightening cycle, and then the market could start to normalize. You could see a bid in bonds, and as I said, a bid in bonds would be compression of rates, which is good for emerging markets, which is good for sectors like tech, and that creates opportunities. So I don't think we're far apart, Joshua. If they, we're in the camp that they don't need to do any more. We've been in that camp for some time. There's a lagged effect of policy, and you got to let it work through the system. They were unwilling to do that. They had to hike as fast as they possibly could. But when we look in the inflation numbers, they've been coming down every single month since July. So it's working. They just need to be patient. They need to pause. They could always go back to tightening if they have to.
Okay.
But these conditions are much different than the 1970s, which they're afraid of. The conditions are nothing like that. and we have debt to GDP at 120%. We can't afford to keep hiking this aggressively. We're going to have to run inflation a little bit above trend, just like we did after World War II, when we brought debt to GDP down from 120% down to 63% by letting inflation run between 3 to 5%. And I think that's a prudent plan moving forward, and that will now allow the market to heal and allow people to get back to business.
Okay, so the perspective, the focus is quite changing from inflation to what happened in the real sectors. And so we also know that these SVB and Signature Bank cases remind us with the Lehman Brothers back in 2008. So from your 2 cents, from your point of view, what's the differentiate between these two?
Yeah, this is nothing like 2008.
Okay.
In 2008, the banks had risky assets on their balance sheet that were declining and had no chance of coming back. You had postal workers that owned 5 houses that there's no way they could afford to pay or refinance. This is a completely different situation. The banks did what the government wanted them to do, which was go out further on the risk curve, but they were so conservative, they were still in government bonds. Little did they realize that the safest investment in the world, the government was working against them and raising rates too quickly, which caused the impairment in the bond portfolios. So, like I said, it's comical what happened. It's not comical, but it's crazy what happened to think that the banks did do the safe, secure bet. They should have managed their maturities a little bit better, but it was largely the Fed that created the unrealized loss, which forced them to sell, which created this cascade effect, and then the Fed had to come in and backstop it. So the Fed's going to have to clean up their mess. They created this problem. They're going to have to backstop the deposits to create confidence and stop hiking so that banks don't have to compete with their own government for depositor money. And if they do those things, I think we could see a boom coming out of this. But there's going to be a few little aftershocks in coming days until the government gets it fully backstopped.
Okay, still from your point of view, it's the Fed to be blamed. Okay, thank you so much, Thomas, for your insights. Terima kasih, Pak Joshua, telah berdiskusi bersama kami. What a very interesting discussion we are having now. Thank you so much, Thomas dan juga Pak Joshua. Selamat sore, sukses dan sehat selalu untuk Anda.
Thank you, Ifa.
Have a good day to you, Thomas.